If you're making over $200,000, $300,000, $400,000, you already know the problem. You're always told, sorry, your W-2 income is fully taxable, rental losses are passive, and there's nothing you could do about your tax situation. For most people, that is true. But what almost nobody explains is this. There are exactly 2 IRS exceptions that block rental losses from offsetting your W-2 income. And high-income earners who understand this strategy have been and are wiping out tens of thousands, if not hundreds of thousands of dollars in taxable income. In this video, I'm going to explain the rule that traps W-2 earners, the only 2 ways around it, and which strategy actually works for most people. So let's start with the rule that causes all the confusion. The IRS says your W-2 income is active income. The IRS also says long-term rental income is passive income because you're not really doing anything to earn that income. Therefore, passive income cannot offset your active income. That's why when you buy a rental investment property and you go to your CPA at the end of the year, say, I have all this depreciation, it's not offsetting any of your income and your taxes owed do not change at all. This is the trap that high income earners get stuck in and repeatedly do because they don't know the exact rules behind it. The tax code does have exceptions to this, which we're going to break down so you don't waste your time or your income. So there's only 2 ways to offset rental losses or real estate losses from your active income. First is real estate professional status, also known as REP. Second is the short-term rental loophole. Everything else you hear online on Instagram and TikTok, that's all noise. Let's break down exception number 1, real estate professional status, REP. If you qualify for this status on your return, your passive losses become active losses. And so now that it is non-passive losses, that active loss will offset your W-2 active income. However, to qualify for this, the IRS requires 2 things from you. Rule number 1, you spend over 750 hours in real estate activities for that year. Rule number 2, more than 50% of your working time for that year is in real estate. However, here's the reality. It is very hard to accomplish this as a W-2 earner, and this gets scrutinized very easily by the IRS. They're very hip to what's going on for REP status. The reason being is you're spending 40 hours per week for your W-2, so to conduct an additional 750 plus hours or to spend more than additional 40 hours per week for real estate, it's not so feasible. Now, here's the pro hack that most people don't know about, which gets you around this. It's called the spousal hack. So the IRS looks at married couples jointly, meaning only one person in the couple needs to qualify for this status. So this works best when you have a spouse that stays and works at home, one of the spouses works part-time, and that same spouse manages the rentals. When done correctly, this strategy unlocks insane amount of tax savings. And this is why you see many professionals who have their businesses, have their spouse doing real estate on the side, and they're the face of the real estate. Ergo, they are doing the real estate activities, and now that they're joint, that other person has REP status, and now those losses are offsetting the active income for the spouse combined. Now let's talk about exception number 2, which most high-income earners use, which is the short-term rental loophole. See, short-term rentals follow a completely different set of rules by the IRS. First, average stay is 7 days or less. Second, you materially participate within these real estate activities. If these are checked off, the IRS considers this as active real estate losses. In other words, you do not need REP status. So this is why you see W-2 earners investing in Airbnbs, short-term vacations, and operating short-term rentals. So it's clear cut about 7 days or less. Let me quickly touch upon material participation. Material participation is measurable. Here are examples of things that count: managing bookings, pricing decisions, guest communications, coordinating cleaners and maintenance. Things that don't count is hiring a property manager and then just disappearing. So make sure you document all your activity and work and time and effort within the short-term rentals. So let's put some real math behind this in an example. You're earning $300,000 as your W-2 income, you get a short-term rental investment property, and you conduct a cost segregation study. Your first year's paper loss for your rental becomes $50,000 in this example. That $50,000 is going to directly offset your $300,000 of income. Let's say your tax rate is 40%. 40% of the $50,000 is $20,000 in tax savings. So, same property, same cash flow, completely different outcome just based off of structure. So who does this strategy work for best? It works best if you earn $200,000 or more, you're already paying massive amount in taxes, you want a legal defensible tax strategy to reduce your income, and you have interest or would want to get into real estate and managing real estate. This is not for people that are just chasing write-offs, it is not for people that want zero involvement, and it is definitely not for people who are going to buy bad deals just for tax savings. Guys, final takeaway, real estate doesn't magically just reduce your taxes owed. Structure does. The IRS rewards people who come into real estate and do things by the book the right way. The code is literally written for you to take advantage of it. High-income earners stop playing defense with taxes and they go on the offense. This is why the rich stay rich and only get richer because they're implementing and exploiting these strategies year after year after year. So guys, if you're a high-income earner and you think you're leaving taxes on the table, subscribe, like, follow. I'm going to talk more about cost segregation studies, other strategies you could implement. I'm going to catch you in the next video. I appreciate all the support. I'm going to continue to grow this channel to try and get you guys to grow your wealth year after year after year so we could do this journey together. I'll see you in the next video.